Hey, welcome back to the Victor H Investing channel. I am a value investor, really focused on trying to buy really good companies that are at a discount, and I can see my investment go up over time. We had quite a day today. We had stock prices really fall, which was a little bit surprising how much they fell today. Um, so I wanted to get into today's stock trading and begin to talk about some of the earnings that came out and that type of information. One thing, a reminder. Hey, how you doing, Shadow Guy? Just a quick reminder that my channel, all my videos are about sharing my experience as an individual investor, and it's never financial advice. And I don't recommend you buy or sell any stock that I cover. This is just for entertainment purposes. So let's get into today's trading. So the S&P went down 1.57% today. That was a pretty good drop. And I thought it accelerated toward the end of the day, which was interesting. That's kind of a sentiment signal to me that people are just, a little scared. There's a little bit of fear out there. The NASDAQ was down 2%. That was a pretty good drop, and you could see at the tail end of the market it really sold off, so people wanted to get out of positions. So that's interesting. If we look at the S&P, over the past month it's down 4% roughly. If you look from the top, which was March 28th, it is down above 4%. So the S&P is down 4% to this point, and as we kind of zoom out, you could see that these pullbacks are just, this is the past year. We had a pullback in the middle of last year, and that was actually officially a correction because it was about 10%. And this little pullback we're having, collectively it's down 4%. It could really go down further, and some things can take us there. We'll see how things play out. Before I get to earnings, I know that, let's just get into Amazon now. So Amazon came out with really good earnings. From what I could tell, it was just amazing earnings, frankly. But it still wasn't enough to kind of turn things the other way. The companies that had bad earnings, which I'll get into, they're really being punished. I've seen some companies where the stocks really dropped, and I'll get into Starbucks in a minute. I wanted to show, I don't know if people view the CNN Fear and Greed Index, and I think it's interesting to look at it. Right now, it's measuring that we're in a zone of fear. Sentiment on Wall Street is in fear. And they measure it by looking at where the S&P is and where the 125-day moving average is. So we're trading above that. Extreme fear because there's been so many companies hitting their 52-week highs. And it kind of gives you a really good measure of how they determine whether we're in fear or we're in greed. The other thing that's interesting is a month ago, this thing was measuring that we were in greed. I agree with that sentiment reading, that a month ago we were, stocks were really priced high. The market was trading really high. And it just kept going up, which was the bizarre part of it is, the stocks go up and down. Hopefully they go up more over time. And they have. If you look at historical data, stock market's worth a lot more than it was worth 20 years ago, than it was worth 50 years ago. You can really see that upward trajectory of a stock market. But at certain points, we are in a greed zone, and that's where I think stocks are really priced high. So most definitely we're in a fear zone, and today's really fast selling toward the end of the trading day really showed up. So big earnings that came out, Amazon being the biggest, just came out 2 hours ago. And just some phenomenal earnings. They're growing their business quite well. Their cloud business is really booming. Their profitability is off the charts. Free cash flow is off the charts. Congratulations, Amazon. Now, I'm sure this is the NASDAQ earnings calendar. I think tomorrow it might be trading at a $2 billion valuation. Right now, they're 1.82 trillion. The stock in after hours trading is up 2.8%, actually 1.6%. So it might not quite get to 2 trillion, but we'll see. It's just shy of 2 trillion. Amazon's doing great. Over the last 5 years, you could see that how was this stock discounted so much? This isn't that long ago. This is about a year and a half ago. But it's really done. Amazon stock has really done well over a year, 72% increase in value. So it's done awesome. So congratulations, Amazon. Going from a big winner today to a pretty good loser, Starbucks. Starbucks did not come out with great earnings. They came out with negative earnings. And the stock is trading down in after hours trading more than 12%. Wow, what a drop. And this stock over the last year, look at this chart. It's down big time. The last 5 years, you can see it's coming down. So this is a dividend payer. And I'll have to take a look at these earnings closely, the quarterly earnings. But to see if, it's being overly discounted at this time, or if they deserve to be going down 12%. It's hard to imagine that, because these guys are the coffee retailer, the coffee restaurant. Their revenue tends to be pretty stable, and I'm going to look into it a little closer. Maybe we can do that later on the live stream. So the stocks that are going down are just getting punished. A few bright spots and that are in the market is 3M did go up today, and that was one of the bright spots in the trading today. So 3M was up 4.7%, which was really a bright spot. There were a few companies that were up today. All right, so looking at other earnings, Eli Lilly was another company that announced, and Eli Lilly is the best run pharmaceutical company in the marketplace. They're a $742 billion market cap company. They had positive earnings. Their stock went up 6%. They're doing really well. Last 12 months, they're up 91.92%. And they're I guess the big news on them is that weight loss drug that they have. So they're doing really well. And hopefully this is a signal that healthcare stocks are going to do better. I know that Pfizer, I believe, announces tomorrow or Thursday. And I'm really going to look forward to that Pfizer earnings. Hopefully they can catch some of this magic that Eli Lilly had for their earnings. So that's another big earnings that came out. Coca-Cola announced. AMD had a good earnings report, but their guidance wasn't as promising as the market would like. I guess the market wants, you to come out with good earnings and then say, hey, not only did we do really well, we're going to do even better in the future, which is hard because, especially semiconductors, they've been talking about good news for 3-4 quarters. So to come back and say, okay, we're going to have even more positive news, must have been tough for them. And the stock is down 7.55% after hours trading. So that's interesting. On the flip side, I think Super Microcomputer is up Oh no, it's down. Earlier, the stock was up after they announced their earnings, and now it's down more than 12%. That's a surprise. It was up, about an hour and a half ago. So we'll see how that plays out. So just the market is really, going up and down. Looks like shadow guy. So guidance mean what? Yes. So guidance, when you look at guidance with a company, let's take a look at an example. I'll look at Starbucks, see if they provided guidance. So a company will announce their earnings. I like to go to the company's website, Starbucks Investor Relations, and you can go by typing in the symbol of the company and then Investor Relations, and it'll have their earnings. I don't like going to like CNBC or anybody else because that's some analyst that puts their opinion on the report. So instead, I go there and then I look at the reports themselves, and they'll usually, come out with what are the kind of headlines. Net revenues are down 2%. Okay. And that is bad news. Not terribly bad. It's down 2%. It's not down 20%. Same store sales, which is important for a restaurant or retailer, down 4%. They open new stores. And let me try to find guidance. So they are looking at the quarter, which ended March 31st compared to the quarter that ended the year prior on April 2nd. That's where the loss of sales. Here we go. So that didn't provide guidance. I'm searching for the guidance. Bear with me. Yeah, I guess they didn't provide guidance on their earnings there. So I'll have to look at it elsewhere. So it looks like Starbucks, their revenue came down, but usually just back to the guidance on the question from Shadow Guy. The stock market really likes smooth upward, growth in revenue. And if you can't provide that, the market doesn't like it. A perfect scenario is a nice, smooth growing company. Let's look at Google really quick. And when you look at their financials, it's just been positive growth on revenue. The market likes that. And they don't like, downward. And the guidance means for the next quarter or for the remainder of the fiscal year that we're in, we're going to have this type of performance. And then analysts will value the company based on what management's saying they're going to do in the next quarter, which kind of sets up the business. Hey, they're doing well or they're doing poorly, they're growing or they're not growing. They're more profitable or less profitable than we expected. They're spending more capital. For example, Meta came out last week and said, hey, we're going to spend more capital, CapEx, and it's going to be upwards of $5 billion more. And the stock sold off. It went down in value because it told investors, hey, we're going to have less cash out of that company. So that's what guidance means. All right. So we're into earnings. We have Coca-Cola came out, AMD, McDonald's had favorable earnings from what I saw. Starbucks, we just covered it. And those are the big players. Oh, the one PayPal had good earnings today. It's good to see that they finally had a good earnings report. They've had, they announced before the market opened and they were up 1.4% in a down market, which is good. And you look at, their growth. This is why I continue to buy PayPal. They've had revenue growth each year. For some reason, they just became undesirable to a lot of investors, but the fundamentals look good. their cash flow has been up and down, but I think investors really like their earnings. They grew their top line, they were profitable, and they provided I think decent guidance. So PayPal is a big winner today. Looking at tomorrow, we have MasterCard, Qualcomm, Pfizer, really focused on that Pfizer earnings because, boy, Pfizer, it needs a positive earnings report. It's kind of been really negative for a while. I mean, look at this chart. Since late 2021 to now, what is that? 2 years and 4 months, the stock's been going down. It came down from nearly $60 a share to $25 a share. And it's paying 6.5% dividend. I mean, this is a really good company. They have really good cash flows and they have really good revenues. They did have a big drop, and this is deceiving because in 2021, they had COVID vaccines that they were selling, and the business almost doubled. So there was nowhere to go but down after that. So, revenue only increased 23% after 2021, and then it dropped because they didn't have as many vaccine sales. So I think Pfizer if they could show growth, I think the stock's going to rally. I think it's heavily discounted. And the company does have a lot of drugs that are really good franchises, meaning that they just get revenue because people have diseases or conditions that they need that drug, and they'll be prescribed that drug and they'll go buy it at their pharmacy. So I'm really looking forward to their earnings. They usually announce before the market opens, so that'll be an early earnings report to take a look at. And fingers crossed, it'll be good. And after hours trading, it's trading up, which is, I guess, a good sign, but it's too early to tell. So that'll be interesting to see. GlaxoSmithKline is another pharmaceutical company, CVS, healthcare. So we got some good healthcare companies coming out tomorrow. Qualcomm's another semiconductor company. Very interested in seeing what they have to say. Qualcomm is really big in smartphones and mobile technology. That's where they've really grew their business. So we'll see what they say about the phone unit sales and how much volumes are happening or how many phones are being sold. Allstate's going to announce tomorrow. That's one that I want to keep my eye on. And those are the ones that I've got kind of earmarked for tomorrow. Looking at Thursday, Apple is going to announce on Thursday. I'm really curious to see what Apple is going to have to say. I think that Apple hasn't had something that's been really exciting in a while. Obviously, they've mastered that iPhone. They've mastered the ecosystem around that iPhone. Great job. But what's the last exciting thing they came out with? Their VR, goggles, those were interesting, but they were not really high volume sellers. I don't even know if they're going to report that as a segment. It was just kind of a interesting gadget. So I don't know that maybe they will have some news around AI or something that they're cooking up that could drive the stock. But I think all eyes will be on Apple on Thursday to see what they announce. Another pharmaceutical company, Novo Nordisk. And then we've got another energy company, Amgen's a life sciences company. Cigna announces on Thursday as well. And then Zoetics, which came out in another live stream we had about a week ago, or last week, I should say. And that's announcing. So a lot of big companies are going to be announcing this week. And then on Friday, Berkshire is going to announce on Friday. Hershey Chocolate. I think those are the big players on Friday, just mainly Berkshire Hathaway. And that's always big news because everybody loves and respects Warren Buffett. and the late Charlie Munger. So it'll be interesting to see what Berkshire Hathaway has to say. All right, so got a request to take a look at NUE. Let's take a look. So that's Nucor. Is this a steel company? Yeah. So Nucor, man, they've been going up. Wow, good chart. They really dropped off in the last, month or so? Yeah, they're down about 15% in a month. Started to go down in April. Okay. $40 billion market cap, revenue. You're paying about 1 times revenue, good profit. And they pay a small dividend. All right. And they announced their earnings. Looks like they announced earnings last week. And they missed on their earnings. Okay, so first let's talk about the industry. So Nucor is a steel company. Steel company materials. Materials are cyclical. Cyclical in a couple ways. The two that I think about most is price. If there's high demand for steel, the price goes up. When the price goes up, Nucor gets to charge more, so their revenue automatically goes up. They could produce the same amount of steel, their revenue is going to be higher, their profit's going to be higher. And the second piece to that is volumes. If the economy is doing well and there's steel bridges and steel buildings, because steel's used in the frames of buildings, and a lot of steel demand, then volumes go up. So in a perfect scenario, it tends to be in growth periods of the economy. When the economy is thriving, there's demand on steel. So right now, I can't say that we're booming. It's probably the demand on steel isn't very high. I don't think it's really low, but I don't think it's booming. So that's my feeling on the industry. I like steel companies. I have a position in a rolled steel company, Ternium, and I'm not opposed to buying material companies. So Nucor is a very well-run company. From what I have seen them in the economy and in news, they're a respected company. They have had a drop in revenue last year, and I think we can look at the quarter. I don't have the most recent quarter. So looking at their cash flow, man, cash has been dropping each year. So you can see that I'm looking at the quarterly, sorry. So looking at the annual, cash from operations, understandably in 2020, it dropped because you had COVID. I think there was, the COVID year, I give companies a pass. And then operating cash flow went up significantly, and then it went up again significantly. Wow, what a rise. And then it dropped. So we're down to about a little under $5 billion of free cash flow. This is probably going to have a good intrinsic value, just looking at the surface, because if you have about $5 billion in free cash flow, and if you're growing that cash flow, the company is going to be worth, above $50 billion. And this company has a market cap of 40 billion. So the fundamentals look good. Looking at the balance sheet, cash and cash equivalents is 7.1 billion. And if we look at debt, current debt is 194 million, and then 6.6 billion in long-term debt. So collectively about 7 billion in debt and 7 billion in cash. So the balance sheet looks good. I think Nucor has good fundamentals, and I think if we did an analysis on this company, it would probably be discounted. The question is, what do you think is going to happen to the steel market? Do you think it's going to have a couple of good quarters and now is a good time to buy? Is it a good time to track the stock and wait for it to fall even further? That's the question that you would ask yourself and start buying at the right time. I tend to buy in a period of time, over a period of time. I find it easier as opposed to trying to find the exact moment when it hits this point here. That's really hard. But it's easier to know, hey, this is a good company and I think it's a good time to buy, and start buying shares over, let's say, this period, which started in September of 2023, and keep buying, buying pullbacks until you have a good position and you're like, okay, I just bought a good company. I didn't have to be good enough to time the perfect bottom, but I bought it at a nice discount, and then I can participate in the rise in the company. Now, when will this one be hitting the bottom? I don't know. This one's kind of dropping quickly, and we're seeing the market sell off. So if the market keeps selling off, this Nucor stock may look really good. So I would encourage you to really do more homework on this one. It looks good from the fundamentals. I would definitely do more investigation on it. I'm going to note it and take a look at it later. All right, good one. Okay, so next comment. I got to hit the hay. Oh yeah, you're in Switzerland. Hey, thanks, Shadow Guy. Thanks for tuning in. Let's talk about Tesla. Tesla any good? So, man, Tesla is, what a stock. If you look at the fundamentals of Tesla, it's not a good situation. And let's take a look at their revenues. Okay, good. So the last closed quarter for Tesla, revenues came down 8.7%. Now, this is a company that has electric vehicles and is the market leader. And if anything, they should just be going, continuing to grow. But they're not. The business is contracting. They have a lot of competition. The other car companies are not standing still, just letting Tesla run alone with EVs. Toyota's out there EV. Mercedes has a really nice EV. BMW has a nice EV. And I can go through every car manufacturer. They all have an EV lineup. So stiff competition in China, stiff competition around the world. So prices are coming down. So everything's like looking more challenging for Tesla in their main business, which is their car business. So overall, I'm like, okay, this stock concerns me. Like, I'd be concerned if I was a Tesla stockholder. And I've done videos sharing my comments. Over the past year, the stock's down significantly. This kind of tells us the wrong story. Let me go to Google where we can really dissect the chart. So looking at Google, right? Yeah, over 1 year, you're there. But if you look at the high, which was July 18th, 2023 to now, it's down 37%. And not too long ago, it was down 51.5%. Wow, what a drop. But very recently, the stock has rallied 36%. Now, what did it rally off of? Comments from Elon Musk. And I agree, he's pretty famous and well-liked CEO, but he promised a couple of things. He promised the robo-taxi, and I think that's so premature for Tesla. And the reason I say that is, like, Waymo is a company that Alphabet owns, and they've been working on robo-taxis for 10, 15 years. It's a very difficult business. So you could say that, oh yeah, we're going to have robo-taxis. And as an investor, that's kind of a head fake to me. Anybody could say anything, but the proof is, okay, when are you going to start testing here in the United States? When are you going to start testing, like really testing cars? Waymo's had cars, being tested in major cities for 10 plus years. They've been testing their technology for a long time. And that's what I'm talking about is there's already companies that are ahead of Tesla. So for the CEO to announce that and then the stock to rally, it's really interesting to me that investors are willing to take his word for it and say, okay, I'll buy the stock at a higher price, even though we're not going to see that revenue for years. If it happens, remember, he promised the Cybertruck like 5-6 years ago. He said it was coming like a couple years after he announced it. It took more than 5 years to deliver the Cybertruck. When he delivered it, the units that they sell for the Cybertruck are really low. So it was, I don't know that so first, I don't invest in Tesla. It's not the right investment for me. I think it's overvalued. And you can look at a video on my channel and I dissect the fundamentals and the financials. But that was a really interesting stock to follow. So the answer to Tesla any good, if you believe in the company and you think they're going to do all these awesome things, well, that's one thing. If you think they're a car company and you got to see the fundamentals, you got to see real evidence that they're doing well. I can't see myself buying the stock. I don't think I'll be buying this stock for a long time, if ever. So that's my feeling on Tesla. Good question, Lynn. Appreciate it. All right, cool. So keep the questions coming. I'll keep rolling with some things that I thought we could talk about. Would like your review of HDSN. Great channel. Thanks. I appreciate the comment, Janet. Let's take a look at HDSN. So Hudson Technologies, through its subsidiary Hudson Technologies company, engages in the provision of solutions to recurring problems within refrigeration industry in the United States. Company engages in sale of refrigerant and industrial gas, provision, refrigerant management. Okay. So they're an industrial, I imagine. So materials, specialty chemicals. Okay, yeah. Materials, not an industrial, a materials company, specialty chemicals. And small market cap, 451 million. The revenue is 289, so about 2 times revenue. Net income profitable, great. No dividend. And they have very low PE, 9.65. Okay, so looking at the industry, materials. I like good material companies, and especially like right now, the economy's not doing great. It's just doing okay. Like unemployment's relatively low. Industrial, activity is pretty good, but not setting any records. I think we have high inflation rates, high inflation rates, high interest rates. And it seems like nobody's optimistic that we're going to start growing anytime soon. And so I think that's important to keep an eye for a couple reasons. One, it's good to buy early, but not too early. And we may be looking at the year before the economy finally starts to grow. And this would be interesting. If you think it's a really good company, you start buying into it, you would participate in a nice rally going forward. The company has been moving up. Wow, it was like a really low price stock. It was $1, $2, $3, and whoever participated in it is doing great. Although last year, 27%, it's been coming down. Looking at the last month, it's down 12%. Okay, so looking at their financials, their sales had been growing, and then they had a couple of tough years. I'll give them a pass on 2020, but then they grew really fast in 21, really fast in 22, and now they're coming down. That is a little concerning. What's going to be the trend, right? Are they going to start growing from this point, or are they going to continue to go down in revenue? So I'd want to get my head around that. See if the quarterly information is out there. No, don't have any quarterlies yet. Cash flow, operating cash flow, 58 million, and they don't have to spend much CapEx. So very high cash flow generating company. Okay, so I think the fundamentals are going to be okay, but the hardest part is going to be, what does the investor think this company is going to do from a growth perspective? Are they going to grow, or are they going to keep contracting? If they're going to keep contracting, it's really hard to value the company, and the stock price might suffer. So that'll be a decision. The forecast on earnings per share, let's take a look at that. Wow. How many analysts? 2 analysts cover this. They both say strong buy, and they have a pretty high stock price target. Interesting. And their forecast is that they're going to do about $1.10 in earnings per share, which is good. Lower than last year. And I'm sorry, I'm looking at the wrong year, excuse me. 2024 earnings per share is 99 cents, and that's going to be lower than last year by about 9.9%. But then they're going to go up next year. Okay, so that's pretty good earnings per share. It looks interesting. The one general thing that I would put out there is my small caps have not been doing well. Small caps have underperformed. I have some quality companies, and they just don't go anywhere because I think investors and people are not familiar with them. And Hudson Technologies, with a market cap of 451 million. I mean, I think the big appreciation has been happening over the last couple of years, but it just doesn't have a lot of name recognition. And investors are really careful when it comes to small caps. So just, I would put that out there, that I'm careful buying small caps because it hasn't been working for me over the last 2 years. I look at these quality companies, I believe in them, and then they don't go anywhere. And it may be different with this one, but I would put that out there. The other item that investors might look at and frown upon is this was a really low price stock. And these tend to be low quality companies. And they may be labeled that way, that, hey, that was a low quality company. It looks like they've had a couple good years. They certainly rewarded anybody who owned the shares back here. They've doubled their money really quick. So those are some comments on Hudson. I would do my homework on it and see when you want to buy. The stock has been coming down. Looking at where the market's at, it may come down even further and offer a good discounted price on this stock. All right, good question. Thank you. Okay, next question is from Lynn. What is the best way to learn how to buy and sell stocks? What kind of stocks should a new person look at? Thanks. All right, very good question. So I'm going to say that the best place to start is where your experiences have kind of prepared you to probably be able to assess a industry and a company. And your personal experiences could be something that you enjoy doing, something that your family's done. Maybe you have relatives that have been really big automotive people, so you understand automotive. Or you have personal experiences where, hey, I really got to know, let's say oil and gas, because I had an internship or I had a job. So look at the things that you've done to this point and kind of take an inventory of, hey, these are my experiences. This is my advantage from an understanding perspective of industries that I've participated in. I'll give you an example. I graduated college and I went to work as an accountant at an oil company. So they taught me a lot about oil companies. I would have never have learned about oil companies if I hadn't worked there. And I worked there and I learned about oil companies and chemical companies, because that oil company, would take the oil and natural gas and convert it into chemicals as well. So that gave me a little bit of a knowledge base to be able to understand an oil company. Well, that could be if I'm a new investor, and I've always been comfortable investing in oil companies because of that one experience. I worked there for 3, 4 years, and they really prepared me to understand how oil prices move and what makes a successful and profitable oil company, energy company. So that's an example. It could also be something that you really enjoy doing. Um, and it doesn't have to be like, hey, I enjoy going to the movies, so I'm going to invest in a movie company. But it could be, whatever it be. Um, so that's the first area is, kind of if you're new, do a self inventory and say, I probably have pretty good knowledge base on these types of companies, these industries, and then kind of do your homework on a couple of them. When you begin to learn about investments, the most important investment is to invest your time in learning and studying a company. And the least expensive investment you'll make is if you tracked a company for a while and you didn't invest a whole lot of money, if anything, because if the stock goes down, you lost nothing, but you learned about it. So those are two things that I put out there. Next is once you kind of find an industry, try to find industry, like don't take on all industries all at once. Maybe focus on one or two industries to get started and really study, what are the best companies. Maybe I can show you an example. I know through the stock screener here, let's say we were going to go and we were going to look at healthcare companies. Hey, you know what? A lot of the people in my family have worked in healthcare. I've got a couple of siblings or cousins that worked at a pharmaceutical company, and somebody near me is a doctor and somebody else is a nurse. So healthcare I kind of have a little intuition when it comes to healthcare. So I could pick healthcare as a sector that I can look at. And within healthcare, you're going to have all these companies. Okay. We can go based on their growth. We can look at size of the company. We can start picking those things out. But then we look at healthcare and we can start tracking some of these companies like Johnson and Johnson is a company in healthcare. It's a pharmaceutical / med device. They do a variety of things. And I could start tracking, okay, how have they done? Okay, I'm going to call this flat because you see how it's gone up and down over time. They pay a dividend. So start studying companies in that particular sector and industry within the sector to try to get a good frame of reference and understanding of, okay, I'm new. I just want to understand these are the companies in an industry that I understand because I've had some personal experiences in. Once you have that sense, you can start trying to value the companies. And I know that I put out some videos where I try to teach, how to value companies. Valuing companies is very difficult. I have an undergraduate in accounting. I worked in industry as an accountant and then in the software industry. Then I have an MBA. And I put together my own model in Excel. Now, you could probably use, my example or somebody else's example and try to value companies. But I think that's maybe more of once you become you're out of that new investor zone and now you're ready to start valuing companies. At first, I would pick companies that you really like, try to get good analyst reviews like this one here, Johnson & Johnson. Some analysts are predicting that the stock price ought to be $166 per share. Some analysts are saying 215 and then a low of 40. So this is really, the dispersion on this one's really broad. A lot of analysts cover this one, but you can just start studying the data. The other tip I'll give you as a new investor is, again, you're a new investor, you do understand healthcare, look at an ETF, look at something that somebody else is going to manage. until you kind of grow your knowledge base and you feel like, okay, now I can start picking individual companies, because picking individual companies is harder. You can do a lot more with it, but it takes a lot more knowledge and experience with it. I kind of threw a lot out there. You're a new person. It's great that you want to invest. The one thing I would put out there is, one of the life lessons that I have for myself, right, to pass along, is when I was 25, I was saving and I was putting money away. And most of my money was going into mutual funds and ETFs. And it was probably the right thing for me to do. But the thing that I regret is I didn't really try to learn when I was 25. I was kind of like, okay, just saving my money and having it go into these mutual funds. And then every quarter end kind of say, oh, how's it going? And maybe make some adjustments there. And I would have been better off if I would have really tried to learn when I was 25. And I think I would have made a far better return in my 30s and in my 40s. I got really serious in my 30s, probably when I was 35-ish. And I started making better returns. And then in my 40s is when I made all big returns on stocks and real estate. But looking back, I'm like, man, if I would have started 10 years prior, I'd be 10 years ahead, it seems. So it's great that you're trying to learn. I commend you. If you're new, no matter what age you're in, you're making a very good investment trying to learn. That was my personal experience on it. Hopefully that helped. All right. So Teutonomy. And I only see a G on there. Any chance you can look up ... G? Is there a symbol? Let's see. Genpack, maybe. So to Tommy, are you looking at Genpack? Okay, cool. So Genpack Limited provides business process outsourcing, information technology services in India and Asia, Latin America. It operates through three segments: financial services, consumer and healthcare, and high technology manufacturing. Okay. So they do what I call is business process outsourcing. A company doesn't want to do collections, so they go to Genpack, and that Genpack will do it. All right. So company has a market cap of 5.5 billion. Revenues, you're paying about 1 times revenue for the company. Good net income. Low forward PE. A high forward PE would be like 25, 50. Average tends to be 10 to 12. Or I should say low would be 8 to 12. And everything in between would be moderate. And then we've got dividend of 2%. Okay. The company is growing year to year, which is good to see. And they are profitable. Good. The company has operating cash flow. Looks like they've been growing it most years. It went down in 2022, but then back up in 2023. And they don't have to put a lot of money back into the business in the form of capital expense. Okay, so this company, what I'm trying to do is comparing, see 5.5 billion, a quick kind of back of the envelope calculation I do in my head is I look at cash flow and I look at 490 plus 58 is going to be about 430. And if you multiply that times 20, that tends to be the market cap of a company. Well, if you multiply 430 million times 20, you're at 8.6 billion. This company is way below 8.6 billion. So you can see that, okay, this one I'm willing to spend more time looking into it because it might value really well. It's in an industry that's not super exciting, and it is needed because businesses need to find a way to lower their cost and getting somebody like Genpact to do certain business processes that they can save money on is a good idea. So cash flow looks good. Income looks good. Let's look at the forecast. So analysts are expecting this company is going to be worth more. All of them. How many analysts? 9. The lowest is price target's $33. Average is $40.56. Stock's only at $30. So on average, analysts believe that it's discounted by 32%. So Genpact's got, I think it's got very good fundamentals. I would also say that for a company like this, man, why is their stock price going down? If the economy goes bad, like, oh no, the economy is slowing down in the US, it's actually good news for Genpact because companies are really pressed to lower their cost of operating. So they need Genpact to come in and replace some of the processes that they're doing onshore with their own employees to offshore with a lower cost model. So this one's interesting. It's got really good fundamentals. The things that, I think I mentioned earlier, small caps just haven't done great. To kind of give a little more data. So this is the Russell 2000. Russell 2000 is made up of, the smaller and mid-sized companies. And if you look at the year return, it's up 11%. But let's compare it to the S&P, which includes the big companies like, NVIDIA and Meta, Alphabet, Microsoft. The S&P is up 20%. But the Russell, which has small and mid-sized companies, is only up 11%. So it's not keeping up with the bigger companies. So that's one thing I would put out there is in my portfolio, and the data is showing that for some reason, small caps are not keeping up with the big caps. Maybe the fear that is out there, investors feel more assured if they buy a big name that they're familiar with. And that's what I put out there on looking at Genpact. Good idea. I think there's value there. There's good fundamentals. And they pay a pretty decent dividend at 2%. So good idea. Thanks for the suggestion. All right, random. Would love to know about you, what you do. What does your business in India do? Okay. So not sure how much I'll go into this question. So about me, I'm an individual investor. I'm more of a value investor where I try to find companies that are discounted and then hold those companies. I'm an active value investor that, I'll buy and sell companies. And I really enjoy it. I think the more I spend time analyzing companies, the more I enjoy it. And I think that's to the extent, if you watch my channel, I think you'll get a more familiar with my approach and the types of investments that I make. All right. Maxwell Zimmer. Wow. This one's a question I may not be able to answer, but let's take a look. What has been your average compound rate in the last 20 years in the stock market? I'm not prepared to answer that. It's a good question, but what I try to do each year is, so I know that we have rates of return, like, here's the example, right? Is for the S&P, and let me get out of this really quick. So the S&P for the last year, it's done 20%, right? And for the last 5 years, it's gone up and down, but it's done 70%. And I compare my portfolio performance against the S&P. In some years, I'm better. Some years, I'm worse. I have predominantly, when it comes to stocks, I have 2 portfolios. I have a growth portfolio and I have a income portfolio. The growth portfolio is probably double the size of the income portfolio. In 2023, my growth portfolio beat the S&P. My income portfolio lagged. It wasn't as good as the S&P. And each year I compare, and each month I track how much money I made or lost based on appreciation, how much income I made from dividends. And really what I'm trying to line up my performance on is how much money I could provide for my family. And, I'm aligning everything that I do toward my retirement, and I should be fine in retirement. I have two sons, and, it's fun to accumulate, savings and wealth, and know that I could pass along, that money to them. So as a rate of return, I respect the fact that I should be comparing to the S&P. That's the number one measure I compare to. And really, I try to put a numeric figure. I think part of that is that probably half my net worth is in real estate. I'm a real estate investor. And you can't easily, go to a website and say, like here, I could easily go and say, what is Apple worth? Well, it's easy. Apple is worth $170 a share. So I could track the performance of my Apple stock every day, every month, every year. But when you own an investment real estate asset, it's not that easy. You have to do your best guess as to, well, did this property appreciate this year? I think so, maybe not, but there's no website telling you it appreciated 2% or 20%. You could measure income because people pay rent to rent our properties. And I think part of my overall goal is to grow my investments so that they are giving me a level of income measured in dollars. One of my goals is I want my income portfolio, which is dividend stocks, to pay me $10,000 a month. I'm not there yet, but it's a goal that I have. And the appreciation rate, the last year, the appreciation rate was really good. And I did really well from a return perspective. So Maxwell, I'd have to really think about what I was doing 20 years ago, by the way. I'm thinking back on, 20 years ago, my son, who's going to turn 24 on May 2nd, well, he was coming up on 4 years. So I was probably playing with my son and really focused on being a dad back then. But good question. Appreciate it. All right. Next one. So Maxwell had another question. Let's get to that one. Also, do you think it's possible for retail trade to beat the market? Yeah, this is a very good question, because I think a lot that's written on the stock market is about beating, as a retail investor, can you beat the S&P, and can you outperform the S&P? And I think that understanding what the S&P is it's a collection of all these stocks, and they tend to collect the best companies in the market. Okay, very good. Now, that in itself, if you look at the S&P, it has volatility. We'll look at the last 5 years. In 2022, it went down in the 20s. I think it was 23, 24%. Okay. And from the top to the bottom. So the S&P in itself has volatility. And I think that there's some value in comparing to that metric. But what I think is more important is, what are you trying to do with your investments? Do you want to buy a house in 5-10 years? Well, that should be the goal. Do you want to retire do you want to retire at 45? That should be the goal. Do you want to retire at 55? That should be the goal. Do you want to retire at, 60, 65? Do you want to leave, your heirs a certain dollar amount? That should be the goal. Because these numeric kind of like, hey, the S&P, over the last 5 years is up 70.95%. I think it's a little bit of, from my perspective, hopefully this doesn't come off the wrong way. It's really feeding my ego. Oh, can I beat the S&P? But if I could look at it and say, I paid for the college education of my older son, without any issue. He went to a really good private school. It was never an issue from the time he decided on which college he wanted to go to the time he graduated. I paid for all of it. No problem. That was one of my goals. Check. My younger son, ditto. I live in a house in a neighborhood where I want to live. And it's a neighborhood that I grew up really thinking was really nice. Well, I live here now. So those are real goals to me. That really means that I get to live in this house. I get to see my sons graduate from a really good university. And that's more meaningful to me than beating the S&P. And then back to my real estate assets, right? I've done really well with real estate, but that doesn't really compare well to the S&P. So back to the retail investor, is it possible to beat the market in the long run? I don't know. And I don't really ask myself that question. What I ask myself is, how much money could I make and how much money could I save up for my family? That's my challenge. And each year I track how much money I made, how I'm accumulating, my net worth. And I put it into value of how it could be useful to my family, to my wife, to my sons, to my mom, to the people that I care about. So different way of thinking about it. Appreciate the question. All right. So Ptolemy, can you look up MC, please? MC. Let's take a look at MC. Okay, Moelis & Company. Am I looking at the right company? All right, so Moelis & Company operates as an investment banking advisory firm. It offers advisory services, areas of mergers and acquisitions, recapitalizations, restructurings, capital markets, transitions. Okay. Small cap at $3.45 billion. They lost money in 2023. Forward P is 30. The stock had a really nice 2021, came down, has never really gone back to its previous highs. Okay. It's had a couple rough years, 2022 and 2023. The revenue has been going down. I guess because if we look at their particular industry, right, they're doing investment banking on mergers, acquisitions. So I think one thing, we haven't seen as many IPOs, mergers, acquisitions over the last couple of years. I think part of it was, some of these companies are getting really expensive. So the acquiring companies like, whoa, it's hard to acquire these really expensive companies. So I think the amount of activities down quite a bit. So I think that's what's affecting this company. This is it's a company that if you really know the ins and outs of this particular area, I think you can make, a very good return. It's not an industry that I find like very easy to understand. And it's not an industry that I'd probably invest in. Operating cash flow is a little bit of an up and down. It went from 429, 936, 32, 158. So it's been kind of a roller coaster ride on operating cash flow, a little bit unpredictable. And then analysts are, let's see here, the high 58, average 49. It's priced right at the average. How many analysts? 8. Well, that's pretty good. Most analysts have a hold. 2 say sell and 1 say strong sell. There's a low price target of 37. So this one here, it's not overly exciting, especially, the last couple of years. It hasn't really done a lot. And I don't know that the economy and the situation with mergers and acquisitions is really helpful to them, very favorable. Those are the high level thoughts that I have on MC. Teutonomy, where do I live? I live in Southern California. Where do you live? Teutonomy? Let me know. All right, Maxwell. What time in your, let me share this with everybody. What time in your investment journey do you decide to purchase real estate and why? Not for living, just for investment. Okay. That's a very good question. So stocks are really easy to buy. You could buy Apple at 10 in the morning and sell it at 11 in the morning. Same day, 1 hour. In, out, no problem. Real estate's a different ball game. There's different ways of investing in real estate. I'm not going to go through every single way. I'm just going to go the way that I invested. So first, I bought my first house to live in when I was 25. And I really pushed to do that. I wanted to do it. I did it. Okay, great. And then I bought my second property it was 25 years ago. So I was 30. And I lived in, that's the house that I'm in right now. And then I started buying houses and condos that I rented out to people. And then that's where, so what compelled me to do that? So I, at that time, felt that real estate was going to appreciate faster than inflation. And I'm going to open up a spreadsheet because it's an important area of real estate that doesn't get talked about a lot. So if you've heard of a leveraged investment, what is a leveraged investment? It means that you didn't invest the full amount of that asset's value. Let me play that out here and show you the rates of return that you can get on real estate. But let me first answer the question you asked is why did I start investing in real estate? Is that I did have some people in my life who did really well. I have an uncle that the guy, he didn't go to college. He was a hardworking guy. He was a really decent man. I look up to him. I just saw him this past Sunday. He ended up accumulating like more than 20 properties that he rented out to people. He became really wealthy, and he's not the smartest guy in the world. He just did it, and he kept doing it. And he bought properties in California as an example. If you bought a property in the 70s, you paid $20,000. That same property is worth $800,000 today. It's just so much appreciation. So I had people like that in my life where what compelled me to do it is I was seeing that they were accumulating very good wealth and I wanted to do it. So I just set my mind, do it. And ended up investing in 6 properties. 2 of them were vacation rentals where, this whole Airbnb thing, it started to really show up, 15 years ago. And we thought, hey, it'd probably be lucrative to do that. And it was. We were doing really well, cash flow perspective. And that was really interesting. It was a lot of work, but it was interesting. So that's what compelled me to get into it. I saw that people in my life that I knew, my uncle, other people. I had a mentor when I was in college. This guy made a lot of money building houses. And he kind of explained to me the real estate. Back to that story I was telling earlier, try to invest things that you understand in. Well, I had some mentors who really explained real estate to me. My uncle, this other guy, his name was Phil. And they explained to me real estate in some of the fundamentals of real estate. Now, what real estate it's a leveraged investment. This is what I mean. So and I'm going to talk about California because I'm in California, and it's cool that you're in Oregon. I love Oregon. I could spend a year on the Columbia River, and it's a really cool state. I've been there a couple of times, would love to go back. All right, so you find an asset, you find a property, and you say, hey, this property is worth $1 million. Okay. And you're like, okay, $1 million property. But you are going to finance it. So you put 30% down. Okay. You put a sizable amount. You've been working really hard and you put up $300,000. Okay. The leverage is you invested $300,000 on $1 million asset. Okay. And okay, so the interest rate on this on the loan, which is going to be 70% loan to value, right? Is $700,000, and just so that we're not going to do a operating income statement on this, but just to look at it. Let's say we're at how much are home loans these days? 7%, 7.5. So let's go with 7% to keep the math easy. So roughly you're paying $49,000 of interest per year. Okay, that's fine. So let's measure a return now, right? So you're like, okay, did I make money or lose money? I bought this property, and let's pretend that we bought it on the first day of 2023. So we've owned it for a year and 4 months. And the property goes up 5%. Okay. Oh, put it on the wrong column. I think it spelled appreciation wrong, but let's keep moving along. So you made 5% because the property appreciated 5%. Well, you didn't make 5%. You actually made this return on the amount you invested, which is $300,000. You made 17%. Okay. That's a leveraged investment. Okay. Because you only put down 300 grand and hopefully the rents are servicing the loan. But let's go the other way. So that's an up market. But let's say it was 2008. And in Southern California, real estate went down about 40% over the course of 3 years. And that's Southern California. Inland Empire was down like 60%. Those were just painful numbers. So let's just pretend that this is 2010 and you bought this property way back in the beginning of 2007. And you lost 40% of your investment. So you're going to go this amount times 40. And you're like, oh man, I lost 400 grand on this investment. Not only did I lose my whole down payment, I also lost another 100 grand. I lost 133% on that investment because I invested in at the beginning of 2007, because it's a leveraged investment. So I answered your question of why I got into it, because people that I saw in my life were really doing well with real estate. I did really well because I bought at the right times. Right now, I think investing in real estate, and I'm just one guy's opinion, one investor's opinion, it's a terrible time to buy real estate. It's just so risky. So, and, I kind of got into real estate. This is a stock channel, so I'll get back to stocks. Hopefully that answered your question. All right. Get back to stocks, excuse me. All right. All right. So Teutonomy, you live in Oregon. That's awesome. Love Oregon. Is this video going to be available later? Yes, it'll be on the channel. Very nice to see you, Sergio. Thanks for tuning in. Teutonomy, 2 more, please. PNW and Ben. Okay. And then I'm going to go about another 10 minutes and then I gotta go. So, okay, let's go with PNW. Pinnacle West Capital Corporation. Pinnacle West, through its subsidiary, provides retail and wholesale electric service primarily in the state of Arizona. The company engages in generation. So this is a power company. Okay. Interesting. Okay. So we understand what electricity is and that it's in high demand. Arizona is a growth state. And what's interesting is Arizona also has a lot of data centers. A lot of companies move their, their computers and stuff to Arizona for some reason. And their market cap is 9 billion. Revenue is 4.7 billion. They are profitable. Forward P of 15.77. They pay a really nice dividend of 4.78. The stock has been going down in value over 5 years. Okay. Price target the analysts have it's pretty much fairly priced. Analysts are saying, hey, it's worth about $73.83. It's trading for $73.65. The revenue, pretty stable, been growing nicely. Okay. In the green, very good. They are profitable this year. They were unprofitable last year. So this is usually where this falls down for me. So here's the cash from operations, 1.2 billion. And here's how much capital you have to put back into the business. And this is why I have never bought into utilities, is it's hard for me to fathom that, okay, the company's making 1.2 billion in cash flow from operations, but then they have to put 1.65 billion back into the business. And it's not different last year. It's not different the year before. So you have to put so much capital back, and that makes sense. They have these expensive power generating properties, and these things wear out. They break. They have to hire electricians and people that really know. They have to have transmission lines, all that stuff. But this is why when you look at a stock like this over 5 years, it's not appreciating, because you basically have to rebuy this business every year. You have to put back more cash than the business generated. And that's one of the reasons why I don't get into utilities. I've tried to. I figured, man, that dividend looks good. Power demand on power is just really high. Now, the energy sector, I invest in oil companies, because if you look at an oil company, it's very different. Let's look at CVX. CVX is Chevron. They explore, find oil and natural gas, and they sell that gasoline or natural gas to the market. And the difference here is, you look at the overview, it's a $300 billion company. Stock chart's gone up. Okay, good. But let's look at that statement of cash flows. They generate $35.6 billion of free cash flow, and they only have to put $15 billion back into the business. So they clear $20 billion of free cash. So this business is more valuable because they're clearing all this cash that they can use for dividends, stock buybacks, put it on the balance sheet, acquire another company, all kinds of good stuff. Okay, so that's a review of PNC. Let's knock out Ben, or BEN. Franklin Resources. Franklin Resources is a publicly owned asset management holding company. Through its subsidiaries, the firm provides its services to individuals, institutions, pension plans, trusts, and partnerships. Oh yeah, I think I'm familiar with this brand. They have fixed income ETFs and mutual funds for people that want to buy this type of. So it's kind of a Vanguard or that type of company for fixed income. That's where their brand is recognized. $12 billion market cap, revenue of $8 billion. Forward P is really low, 8.76. Big dividend over the last 5 years. Wow, just sideways. A lot of volatility. Crazy. Okay, so price targets, analysts think it's discounted by 22.7%. The company, from top line revenue, the revenue's been going down, not terribly, but it's been going down. But 1 year here, it went up in 21. I guess everybody saw that interest rates are going up. Let's invest in fixed income, which is bond related investments. And they got into the market. Okay. cash flow, operating cash flow of 1,139,000,000. Take away CapEx, we're left with about 1 billion. Okay. And last year was better. Year before was good. And they are at 12. Yeah, this company is looking good. Okay. We talked about the forecast. Average forecast is 22.7. This is an interesting stock. Very high dividend. It has a lot of volatility, so you can catch it on a low point. They have very strong fundamentals. This is looking like a good company to investigate and take a look at. Thanks for the suggestion. All right. So can you suggest other good YouTubers? Yeah. So Scott's due diligence is right there. So I would say that I like looking at other investors. Now, I don't follow what they do to a T, and but I think I get something out of every single investor I watch. If anything, I appreciate the sentiment that's out there, like, oh, the stock market's overpriced, or hey, they evaluate a stock that maybe I'm interested in, and they have an opinion on it. So every channel I think is useful just to get people's feeling on a particular company. My favorites, my go-tos. Let's take a look at my YouTube. All right. So the investor channel's kind of interesting, except he kind of puts a lot of information out there, and it's probably my brain it's just too much. It's too much, and it's kind of it just kind of runs for like 10, 20 minutes. But sometimes it's really interesting. He does make a lot of good points. The investor channel, everything money. This one's got a little too much like showmanship in it, but sometimes they have some pretty good thoughts around the market and a particular stock. So there's something to be gained there for me. Couch Investor, again, sometimes he comes out and analyzes a company, and I'm like completely opposed to what he's saying. Sometimes I completely agree. But in every single video, I get something out of it. He might look at a particular company, and he might look at like CapEx a different way. And I'm like, oh, that's a really neat way of seeing that, or looking into it. So I watch Couch Investor once in a while. And then, Mad Money with Jim Cramer. I think a lot of people love and hate Jim Cramer. I really like getting a sense of sentiment from Jim Cramer. I don't follow his stock tips. I think he has too close of a relationship with CEOs. Once he has a relationship with a CEO, all he does is pump that company up. But I think if you listen to him around sentiment, he's usually pretty good about it. So I would put that out there. So as you can tell, I don't like watch one channel religiously. I try to form my own opinions on companies, but those are a few examples that answer the question. All right. So, and I forgot to share the comments. So there it is. Okay, cool. Yeah. So Scott, with Scott's due diligence, I owe a lot to him because I've been watching his channel for since early 2020. So I guess that makes it 4 years. And I've learned a ton because he's just like, he goes step by step. He breaks every piece apart. And I would like at the very beginning, that'd be a very good channel. If you want to learn how to value a company based on free cash flows, that's a good one. And I learned a ton. So I owe a lot to Scott. Good guy. All right. So I think Squags, you joined mid when I got asked about real estate. So thanks for bearing with that example. UPS. All right. So man, I looked at UPS recently, and what did I? So UPS has been on a kind of a downward slope. I think very highly of UPS. It's kind of, so one of the jobs that I had, right? This is going back a long time ago. I think I was 19 or 20, and I got a job at UPS for a winter season. And it was on one of my school breaks. And man, that's such a well-run company. I've worked super hard. It was super fun. My manager was one of the best managers I ever had. I would like not need to go to the gym when I worked there, because I would be like, it would be pouring sweat at the end of the night. I'd work like a 4-hour shift, unloading trucks, loading trucks. And I handled, I don't know, a gazillion packages in any one night. But it was such a fun experience. And I just worked for the season. They offered me more permanent employment, but I had school to tend to. So I politely said no. All right. So let's talk about UPS. $125 million cap company, $90 million in revenue, good solid net income, good dividend, and analysts believe that it is discounted by 12%. I think everybody knows what UPS does. They deliver parcels, and they do it predominantly in the US, but they also go internationally. And their revenues dipped in 2023. Okay. But look at the go-go years here, man, growth every single year, especially in 2020 when we were all locked down ordering stuff, 2021. And then they had a decline in revenues. We look at cash flow, 10 billion in operating cash flow, CapEx of 5 billion. So they have about 5 billion in free cash flow. The year before it was far better at around 10. And 21 was even better, around 11. And I think that's where the valuations kind of break down is, what do you use? Do you use a 3-year average, 5-year average? And my concern with doing that is that you're averaging in potentially some of the best years these guys will ever have, right? We had a pandemic. Everybody was in lockdown and you had to order your stuff. Well, we're not going to have that for another 100 years if you follow like the pandemic timing. Now at 5 billion, it's going to be hard to value this company. It's a $125 billion company. Remember how I made that comment earlier in the stream where I said, if you multiply free cash flow times 20, it gets you kind of in the ballpark. And if we multiply 5 billion times 20, that's 100 billion. And that's below their market cap. So I think this is going to be a stock that it's going to be hard to value right now. If their free cash flow begins to increase, I think the stock price is going to go up. The valuation is going to go up. But I think that's one of the reasons why it's dropping is the valuations are dropping for the stock. Okay. But from a brand perspective, quality of company perspective, very high quality company. And suggestion on a channel, Kevin Burgess. I'm going to write that down. I'll take a look at that channel. Thanks for the suggestion. MPC is a company I like. Okay, MPC. Marathon. Oh yeah. Let's see here. Yeah, they're doing really well. Marathon Petroleum Corporation, together with subsidiaries, operates integrated downstream energy company in the United States. Yeah, they're doing really well. 65 billion. They're up 49% in 1 year. Year to date, they're up 22%. And it's a good one. 2% dividend because they've appreciated so much. It was probably paying a 4% dividend, maybe 5% dividend when a year ago. Price targets of 7%. Very good. Income was down in 2023. Excuse me, revenue was down in 2023. That surprised me. Operating cash flow 14 billion, capex 2 billion. Oh, phenomenal. $12 billion of free cash. And the year before, 14. Year before, 3. Whoa, that's a big jump. What happened? How did they go from 4 billion to 16 billion in operating cash flow? Wow. Did they acquire a company? That is phenomenal. 275% growth. So this one looks good, especially if you bought it 2 years ago. Really impressive cash flow. I would want to get, it's always hard to, do a forecast for a company where you see this type of growth, where you're like, okay, 2.4 to 4.3. Okay. Then you go to 16, you're like, whoa, that's a huge jump. And then you're down to 14. So what do you use as your forecast? Do you expect they're going to keep doing, 14 billion in operating cash flow? So you got to investigate what happened in these years. I guess 2020 is understandable. We had lower fuel consumption because you had everybody, COVID lockdowns. You had less people driving. Okay, that makes sense. Because before in 2019, they were at 9.4 billion. See, it's easier to get from 9.4 billion to 16.3 billion. So I'm beginning to get more comfortable around these numbers. So I would take these numbers, almost take them out, because we're not going to have a pandemic every year, right? It's going to happen every 100 years. So very good one. Good example. I think oil is coming down a bit. We'll see where it ends up. But oil at $80 a share. I know in California, we're expensive when it comes to gasoline. We pay $5.50 a gallon. And that's pretty high. It really adds up when you fill up your tank out here. All right. So, we're coming near the end here. Teutonomy, thanks for the comment. Appreciate it. And then the last one we'll do here is RS. And then we'll call it quits. Reliance Steel. Okay. So Reliance Steel operates diversified metal solutions provider, the metal service for center in the United States. Okay. So it provides metal products, including steel. Market cap is 16.3, 14.8 billion in revenue, and low dividend of 1.55. Wow, look at that chart. That's a beauty. Wow, that's a nice chart. See how it just goes up and to the right. That is what you want to see. And they went up and to the right. They pretty much have tripled in value. So this was about a $5 to $6 billion company in 2020, and now they're 16 billion. All right. So their revenue. So the revenue has gone up over time. Hasn't been smooth like their stock chart. Okay. And cash flow hasn't been smooth like their stock chart. They have about 1.1 billion in free cash there, 1.8 billion in free cash there. This is about 600 million. So yeah, this one's a really good quality company. I'd be surprised if you're getting a huge discount on Reliance, just because you look at the stock chart and you're like, whoa, is it going to keep going up and to the right? Just keep going up and up. And especially since they're in a commodity, because I think we saw Nucor earlier in the stream, and they're having a similar experience, right? It's going up and to the right. But I'm looking at the wrong company, sorry. So NUE, Nucor. So these guys are also going up and to the right. Man, steel companies. Awesome. Yeah, I mean, really impressive how the returns in steel have been. And maybe there's something there. Good examples. All right, everyone. So I think that was a good stream. I really appreciate everybody tuning in. Let's see what the market does tomorrow. Let me take a quick peek and see if the futures pre-market, according to CNBC, we're supposed to open lower tomorrow. So we might be at the beginning of a continuation to the pullback. We'll see where the market goes, and it'll be interesting to watch it. Everybody, thanks for tuning in. I really appreciate it. Everybody have a good night.